So you're close to retirement or already have retired? That's great news. The bad news is Uncle Sam still wants to tax your income during retirement, unless you're strategic and follow some simple rules. I'm going to introduce 5 common mistakes that new retirees make that could cost them in taxes. Be sure to stick around for mistake number 5 that could be the costliest. Hi, I'm Scott. I was a college professor for many years, and now I teach couples like you close to retirement how to clarify your goals, master your money, and gain confidence as you enter the next chapter of your life. So stick around. Mistake number 1, not planning withdrawals strategically. Recognize that when you start to generate income during retirement and pulling money from various accounts to live off of, you're going to have multiple streams potentially. You're going to have money coming from Social Security, pensions, withdrawing from your IRA, from your savings, or what we might call your taxable or brokerage account, maybe withdrawing from a Roth IRA. All of these sources generally fit into one of 3 buckets. Taxable accounts, those are your savings, your brokerage accounts that you're going to be withdrawing from. Think of this as sort of your savings. Your tax-deferred accounts, which typically is your IRA, meaning that you're going to pay taxes later, but you didn't pay taxes when you contributed. You've got your tax-free account or your tax-exempt bucket. That's going to be your Roth IRA. So as you pull money from that, it's not taxed. Could be your health savings account. And then you've got things like pensions and Social Security that pensions will almost always certainly be taxed at the federal level at least. Social Security, maybe, maybe not. We'll get more to that in a moment. Now please understand that all these rules I'm going to talk about and all these recommendations are going to be based on federal tax law. Your state could vary greatly, so that's up to you to do your own homework. Mistake number 2 is ignoring tax brackets. Now, unfortunately, the federal government has created a really complicated tax system, as you probably know, and we have what's called a progressive tax rate, progressive tax system. This means the more money that you make, the higher tax rate that you pay. But being well aware of these tax brackets can allow you to make some important decisions and be careful with how you choose to pull money from these various accounts. So let me put my professor cap on just a little bit and remind you of some of the basics of our tax system. You as a married couple get to have what's called a standard deduction. Now, in this example, I'm going to show it as $30,000. Technically, it's $31,500, but I just want to make the numbers nice and easy to remember. So you don't pay any taxes on those first $30,000 of income. Now the next $24,000, you're taxed at the 10% rate, or we call this the 10% bracket. So combined with the $30,000 deductible and this additional $24,000, you can earn up to $54,000 in paying what's called the marginal tax rate of 10%. The next tax rate is 12%. That means you can earn an additional $73,000 that is taxed at 12%. Combined with the 2 lower levels, deductible and 10%, brings your total income up to $127,000 that is going to be taxed up to 12%. Now during retirement, that might cover most of us. Most of us are not going to have an income above $127,000. But let's take a look at a couple of the others. The next one is the 22% tax bracket, and that allows you to earn an additional $110,000, bringing us up to $237,000. So we once again call this the 22% tax bracket and up to $237,000. And there's more, and I'll show you one more, and then I won't go crazy with the rest of them. The 24% tax bracket takes you up to, you could earn up to $425,000. But for most of us, we're going to focus on the 12% tax bracket, earning income up to $127,000, and then maybe the 22% above $127,000, but less than $237,000. Now, are you 65 yet? Turns out that's important this year in 2025. Because of new tax legislation, for the 4 years, 2025, 6, 27, and 28, seniors, defined as age 65 and above, get an additional $6,000 deductible. Now, that, in theory, will go away in 4 years. But if both of you are 65, then that's an additional $12,000 that you can add to that bottom bucket. So although the standard deduction was $30,000 for most of us, at least younger than 65, if both of you are 65, we're going to increase that from 30 up to 42,000 for the deduction now, plus the additional 24,000 for the 10% bracket, and that pushes that 10% bracket up to 66,000. And the same would happen across all those brackets. So I won't mention this going forward, just recognize if you are currently 65, then you've got even an additional wiggle room on how you play around with your tax strategy. Mistake number 3 is ignoring how Social Security benefits are taxed. Have you started Social Security yet? If not, this doesn't apply to you just yet, but it will. So you may recognize that or have heard that sometimes your Social Security benefits aren't taxed at all if you have a relatively low income. The more income you have during the current year, the more of your Social Security benefits that are going to be taxed. So I'm going to run through a sort of a mind exercise to see how could we get away with not paying any taxes on Social Security. So here's some of my assumptions for this example. The couple earns $30,000 from Social Security benefits. Now the first rule that applies by the IRS is what's called your combined income. That's all your other income other than Social Security, for the most part, plus half of your Social Security. Now the threshold is pretty low. It's $32,000. So if your combined income does not exceed $32,000, then none of your Social Security is taxed. So we're going to go with that. Now above $32,000, it starts to be taxed at a little bit, and then eventually, pretty quickly actually, 85% of your Social Security will be considered taxable. But we're playing this game to see how can we get by with not having any of our Social Security taxed. So the first goal then, or the strategy, is how do we keep our combined income below $32,000? So remember, that's half of our Social Security, which in this case, all of it is $30,000, therefore half is $15,000. To get up to that 32, there's an extra $17,000 that we can withdraw from our IRA to get us up to that 32,000. Now, if we just stopped right there, didn't have any other income needs, and we retrieved $17,000 from IRA and our $30,000 from Social Security, we will not have triggered taxation of Social Security. But let's suppose we need more than that to live on. How else can we retrieve money from some of these accounts that we have without increasing our combined income of $32,000? Well, we can pull money out of our Roth account. Roth is not taxable. It does not go towards that combined income. So let's suppose we pull, $10,000 from that. If you're fortunate to have a health savings account and you've got some medical expenses each and every year, who doesn't, given that you can pay for Medicare premiums out of HSA accounts, let's pull $7,000 from that. Now $7,000 from an HSA is handled exactly like a Roth in that it's not taxed. So now we've added 10 and 7 is 17,000. Now let's also assume we've got this third taxable bucket. We've got some savings from that, and we can retrieve 20,000 from it. That's also not necessarily going to be taxed. It's a little tricky. I won't go into the details, depending on what you sell from that, if you have investments. But let's just for now assume that that 20,000 is not taxed. And then we got the other half of our Social Security that we're getting anyways. So if we combine all these sources, we get up to an income of $84,000 for this year. More than half of it not taxed or not taxable. And so we're going to have a zero tax bill that year. And none of our Social Security was taxed. Now, reality is you may not be able to play this game each and every year. You may not be able to play it at all if you don't have much in a Roth IRA or a health savings account. But I introduced the concept to you so that at least you can be aware, put it on your radar as something that might work out for you. Mistake number 4 is not being aware of IRMAA surcharges, or Medicare IRMAA surcharges. Perhaps you've heard this. The federal government's going to try to increase your Part B Medicare premium if your income is too high. So if you're already started Medicare, you know that this year you're paying $185 per month for Part B. That's for original Medicare. Well, if your income is above $212,000, instead of paying $185, federal government's going to charge you an additional $74 per month. And then in this chart, you can see the cutoff for the next level of income, which increases the premium even further. And if you saw this full table, you would see there's actually several thresholds. But I'm assuming most of us are not going to get to that $212,000 limit. In fact, less than 10% of Medicare recipients are ever exposed to this IRMAA penalty, but it's nice to be aware of. So that why could that be important? Well, just like that exercise we did with Social Security, we could do that same thing to be careful not to exceed $212,000 of income. Now that's gross income, so we wouldn't include deductions and so forth, but you could take some advanced planning. Now what makes it a little trickier is that the IRS is not looking at this year's income, but they're actually looking at 2 years prior. So here you are, 2025, at the end of 2025, they're going to set your premium for next year, for 2026. They're going to take a look at your tax return from 2023 and see what your income was. At that point, did it exceed $212,000? Mistake number 5, and possibly the most costliest, or it may not apply to you at all. Of course, I'm talking about Roth conversions. This is probably the most overused term in our business. I'm sure you've heard of it and may or may not understand what it is. So a Roth conversion is simply the ability to move money from your IRA to your Roth IRA. During that process, since you're retrieving money from your IRA, you have to pay taxes on that. But once you put it into your Roth, it's no longer taxed going forward. So why would you do this? Well, the only reason you'd even consider this is that if you believe for some reason this year's tax rate, this year's marginal tax rate is less than what it's going to be in the future. Now, why might it be more in the future? Remember, we've got this progressive tax structure. So in the future, why might your tax rate go up? Because of your required minimum distributions, your RMDs. So at age 73 or at age 75, depending on your current age, the government says, okay, you've got to start taking money out of your IRA. Now, presumably you've already been doing that between now and then. But at that point, depending on the size of your IRA, what they ask you or force you to take out might be a pretty big number. Now this means, the good news is that you've got a pretty big IRA that's causing this issue. But let's just work through and think about this. So if we want to try to reduce the size of our IRA, it's so that we will have smaller RMDs, required minimum distributions, because they're based on a percentage. That first year, it's about 4.5%, I believe, of your overall income. So nice round number, if you're fortunate enough to have $1 million in your IRA, you're going to have to retrieve approximately 4.5%, which is $45,000. Well, that may not be that big a deal for you. Maybe you're going to be retrieving that anyways to live off of. In that case, it's not a concern. But if you've got a larger IRA and they're requiring you to retrieve more money than you otherwise would have, that might push you where? Above the 12% bracket, that $127,000, and into the 22%. So where I think it's pretty beneficial for all of us is take a look at your income this year, project out what it's going to be by the end of the year. And if you're firmly in that 12% bracket, remember up to $127,000, let's suppose you need to live on $100,000, which is still pretty decent for most folks. That leaves you an extra $27,000 that it keeps you within that 12% bracket. So you might choose to do a conversion of $27,000 from your IRA to your Roth, because that's going to be taxed at only 12%, which is pretty darn low compared to what it might be in the future. Now, some of you might choose to also do this at the 22% bracket, but I won't go there for now. So there you have it. 5 mistakes that retirees often make that could cost them with taxes. But being just a little strategic, being aware of all these strategies allows you to reduce your taxes. I make these videos to help you to clarify your goals, avoid costly mistakes, keep taxes down in retirement, and generally just make you more confident as you move forward to the next chapter of your life. Unlike traditional advisors, I don't charge an asset under management fee. Instead, I charge a flat fee to help you create a custom retirement plan. To learn more about me and my process, click on the link down below in the description, take a look around, and then schedule a free introductory call. Until then,